Hey everyone, welcome back to The Explainer. So we've spent the last 6 modules really getting into the weeds, mastering the mechanics of cash and treasury management. But today, we're shifting gears to Module 07, Common Fraud and Control Risks. Honestly, you should think of this as your survival guide. Look, cash is the absolute most liquid asset in any business. It leaves literally no physical trace once it's gone, which is exactly why pretty much every major business fraud scheme involves cash at some level. So let's get you ready to defend it.
Now, you might be wondering, why did we just spend 6 whole modules learning such incredibly strict cash rules? It's so easy to look at things like authorization matrices, dual approvals, or reconciliation lockdowns and just roll your eyes, thinking of them as bureaucratic busywork designed to slow your day down. But I really need you to completely reframe how you view these processes. They are definitely not busywork. They're an active daily defense mechanism against constant threats. Make no mistake, fraudsters are out there right now trying to trick your company out of its cash. And that brings us to a harsh but super vital truth. Yes, we follow these controls to protect the company's cash, absolutely. But just as importantly, we do it to protect you. Let me speak to you like a frank senior colleague for a second. If cash goes missing from your department and the established controls were bypassed or ignored, well, who do you think becomes the prime suspect? It's the junior accountant who touched the transaction. Understanding these fraud schemes and strictly following the rules isn't just about corporate security, it is literally about protecting your personal reputation and your entire career.
Okay, let's dive right in by looking at the absolute most dangerous threat you're going to face: business email compromise, or BEC for short. This is when a criminal sends a fake email that looks exactly, and I mean exactly, like it's from a company executive, a vendor, or a partner. They might impersonate your CFO and say something like, "Hey, I'm in a confidential meeting. I need you to wire $50,000 immediately and do not tell anyone." Or maybe they impersonate a vendor you've paid for years, asking you to update their banking details for all future payments. These emails are incredibly convincing, and they rely heavily on creating a false sense of urgency so that you just bypass your normal caution.
Now, what's really terrifying about this threat is the number you're looking at right here, $100,000. That is the average loss per business email compromise incident. It's huge, and the reason BEC attacks primarily target wire transfers is that wires are instantaneous, and they are irrevocable. Once you hit release and that money actually leaves the company's account, recovery is incredibly rare. The money is just gone.
So, the absolutely crucial point is, how do we stop this? The rock-solid, non-negotiable shield against BEC is the callback verification protocol you see here. If you ever get a request to change payment instructions or send an urgent wire, here is what you do. Step 1. Do not update anything based on the email. Just don't do it. Step 2. Look up the vendor's phone number from your internal historical records. Never, ever use the phone number listed in that suspicious email. Step 3. Call them to confirm. Step 4. Document the date, the time, and exactly who you spoke to. And finally, Step 5. Get a supervisor sign-off before making the actual change. Seriously, one simple phone call stops the vast majority of these $100,000 losses dead in their tracks.
And, this strict matching of a specific threat to a specific defense applies to other common attacks as well. Let's look at check fraud, where criminals alter or counterfeit checks. The key control here is positive pay. It's actually brilliant. You send the bank a list of every single check you issue, and if someone tries to cash a check that isn't on your list, the bank just automatically rejects it. Boom, stopped. For ACH fraud, where unauthorized electronic debits hit your account, we use ACH filters and blocks to ensure only pre-approved companies can pull money. And for payroll fraud, like someone adding fake ghost employees to the system, we use variance analysis to investigate unexplained payroll spikes, and we make absolutely sure the person approving payroll is completely different from the person transmitting the ACH file. Every single threat has an exact matching defense mechanism.
All right, now let's talk about an internal threat. It's called lapping. This is a fraud scheme that is specific to accounts receivable. Basically, an employee steals customer A's payment. To hide the theft, they take customer B's payment and apply it to customer A's account. Then, they use customer C's payment to cover customer B, and so on. It's essentially a Ponzi scheme running right inside your AR ledger. And this perfectly illustrates why you might suddenly get customers complaining that their recent payments haven't been credited to their accounts. The math is always playing catch-up, always one step behind the theft.
So, how do we stop something as tricky as lapping? Well, we use Section 1, the armor, which is segregation of duties. This is way more than just a best practice. It's the structural system designed to make schemes like lapping mathematically and logistically impossible for a single person to pull off.
Let's break down exactly how this armor works in practice. Segregation of duties means isolating three very specific roles: receipt, recording, and reconciliation. Receipt is receiving and logging the physical cash or checks. Recording is posting those entries to the accounts receivable or payable subledger. And reconciliation is tying the bank statements back to the general ledger. If you mix these up, you enable theft. Think about it. If the exact same person who receives the cash also gets to record it in the subledger, they can easily pocket the cash and just manipulate the records to hide it, which is exactly how lapping happens in the first place. 3 people, 3 separate functions. That is the rule.
I want to pause here for a second and really reiterate the personal stakes of this concept. Combining these duties doesn't just create a massive fraud risk for the company. It puts you, the junior accountant, in an impossible position. If you're asked to both receive the checks and post them to the ledger, you need to push back. Insisting on segregation of duties actually proves your innocence by design. If money ever goes missing, but you only had access to one part of the process, the system itself clears your name. This control, it's your personal career bodyguard.
All right, so we've built the armor. Now let's move on to Section 2, the radar, spotting red flags. As you gain more experience, you really need to develop situational awareness. You've got to know the exact warning signs to watch for in your daily routine, so you can catch these issues before they turn into major losses.
Let's rattle through these red flags like a veteran. If you see a secret executive wire request, that is almost certainly BEC fraud. What about growing unapplied cash? Well, if you remember back from Module 2, if unapplied cash keeps growing and no one is resolving it, that's a massive red flag for a cash application failure or possible theft like lapping. Checks outstanding for 4 or more months, they might have been stolen in cash somewhere else. How about someone in Treasury doing the bank reconciliations? That is a massive conflict of interest. They move the cash, they absolutely cannot be the ones checking the math. Unexplained payroll spikes, or a bank reconciliation that just isn't getting done on time? These are all glaring signals that a control has failed, or worse, fraud is actively happening right under your nose.
So let's say your radar just pinged. You've spotted one of these red flags. What do you do next? We move to Section 3, Emergency Protocol, how to escalate. Let's walk through the exact steps you need to follow the very moment you see something suspicious.
Here is your 5-step strict protocol. First, do not ignore it. Small red flags usually signal much larger problems. Second, alert your manager or supervisor immediately. Seriously, do not try to fix it yourself. Third, document exactly what you saw, when you saw it, and in what system. Fourth, do not confront the person involved. You are an accountant, not a detective, okay? Confronting them just gives them a chance to destroy evidence. And fifth, follow your company's formal fraud reporting procedure, whether that's an anonymous hotline or reaching out to a specific compliance officer. And let me assure you right now, you will never, ever be punished for escalating a legitimate concern in good faith. It is exactly what you are supposed to do.
I want to leave you with a really powerful thought directly from the source material. Every frauds case ever investigated involved someone who thought their controls were adequate. Fraudsters don't usually hack into systems with complicated computer code, they hack human nature. They count on you being way too busy to do a callback verification. They count on you being too polite to question a vendor's weird email. Skipping controls just for the sake of convenience is exactly the opening they are waiting for.
And that brings us to the end of our survival guide. Next up is Module 08, where we're going to cover the Quick Reference Guide, which is essentially a consolidated cheat sheet you should keep right on your desk during your first few months on the job to make sure you stay out of trouble. But as we wrap up this explainer, I want to leave you with one final provocative thought. If someone sent you an urgent, highly confidential email today asking you to bend a rule just this once, would your controls protect the company, or would they leave you holding the bag? Keep your armor on, keep your radar up, and I'll see you in the next module.